Welcome back to the deep dive. If you're with us, we look at the source material every day to cut through the noise. And today, wow, what was a market just plagued by these short-term capitulation fears has done a complete 180.
It really has.
We've seen a dramatic structural pivot. This is so much more than just a simple price bounce.
That's the crucial observation. When you look at the sources, the theme that just jumps out is this: simultaneous crystallization of two enormous forces. You have the sovereign bid on one hand, and this massive acceleration of regulatory integration on the other.
So this isn't about retail getting excited again.
No, not at all. This is a fundamental re-rating of risk. We're watching digital assets shift from, high speculation territory into strategic reserve territory for very, very serious players.
Okay, let's unpack that. Let's start with the biggest headline, the one that I think shattered a major psychological barrier just this week. The state of Texas is officially in the Bitcoin market.
This cannot be overstated. I mean, when a state treasury, an entity legally mandated to be fiscally conservative, makes a move like this, it creates a precedent. Other states, even other countries, they now have to acknowledge it.
We have confirmation, right? The Texas Treasury Safekeeping Trust Company confirmed a purchase.
They did. A strategic purchase of Bitcoin.
And the way they did it is so strategic. They didn't just buy Bitcoin. They used BlackRock's iShares Bitcoin Trust, IBIT. Now, the initial value is somewhere around, what, $10 million?
Yeah, reports vary a bit, but $10 million is the number floating around.
So here's the question. If Texas ultimately wants real self-custodied Bitcoin, why are they paying BlackRock a fee to use an ETF? What's the trade-off here?
It's a genius workaround. It's all about an outdated legal framework. Many state investment laws, they're governed by something called the prudent investor rule.
Right, which means they have to be super conservative. Gold, short-term treasuries, that kind of thing.
Exactly. Buying spot Bitcoin directly with all its volatility and custody headaches, that challenges the rule. It would require, a lengthy legislative change.
But the ETF IBIT, that's classified differently.
Perfectly put. IBIT is a regulated security. It trades on a major exchange. So by using the ETF, Texas immediately satisfies the current rules because they're buying a regulated product, not a volatile spot commodity.
Oh, it's an operational bridge, a way to get exposure right now.
It's a bridge solution. They get the exposure immediately, and the buy itself legally legitimizes the asset as a treasury component.
And their long-term goal is probably still bringing it in-house, maybe something like the Texas Gold Depository model.
That seems to be the end state, yeah. Physical self-custody in Texas. But the speed of the ETF purchase creates this enormous FOMO pressure on other states.
Like Florida, Wyoming.
Florida, Wyoming, you name it. They're all competing for tech talent and, frankly, for financial sovereignty. Texas just used its financial structure to get a huge first-mover advantage.
Okay, from the state level, let's shift gears. Let's look at corporate accumulation and the flows that are driving this rebound. We have to talk about Metaplanet.
Yes. The MicroStrategy of Japan.
It seems like it.
Well, Metaplanet is pursuing let's call it a high-octane leverage strategy. It is the polar opposite of the conservative Texas approach we just talked about.
So what did they do?
They just secured another $130 million loan, specifically to buy more Bitcoin. That brings their total BTC-backed borrowing to around $230 million.
Whoa. Okay, that sounds like a massive bet. They're using their existing Bitcoin as collateral, right?
Yeah.
I mean, what's the structure of that debt? Aren't they setting themselves up for a catastrophic margin call if Bitcoin has a bad night?
You're raising the perfect challenge. It's a type of debt called Lombard credit. Think of it as flexible, short-term, asset-backed debt. The big risk, and you hit on it, is that the loan renews daily.
Daily.
Every single day. And the interest rate is floating. So they are extremely exposed to any short-term liquidity shocks.
That seems insane. Why structure it that way?
It's a pure efficiency play. They minimize fees, they maximize flexibility, and they get capital immediately. They're making a very aggressive tactical bet that Bitcoin's long-term appreciation is going to crush the cost of that short-term funding.
And this is all happening while we're seeing a big reversal in the ETF picture. After a brutal week of outflows, the U.S. spot Bitcoin ETFs saw net inflows of about $129 million.
And that flow reversal is crucial. It basically confirms that the institutional selling was probably technical, maybe panic-driven, but it wasn't a structural abandonment of the asset.
The allocators were just waiting for the dust to settle.
It seems like they were waiting for confirmation that the $86,000 technical floor would hold before they jumped back in.
Yeah.
And the fact that IBIT keeps seeing accumulation, now with Texas on board.
It's becoming the sovereign preference.
It really is. The trust and liquidity of the BlackRock brand are making it the go-to institutional vehicle.
Okay, let's pivot away from Bitcoin accumulation for a minute and look at the infrastructure and the regulatory thaw that seems to be happening for the broader ecosystem. There was a huge signal for Solana this week.
A huge signal. Franklin Templeton filed a Form 8A with the SEC for its proposed Solana ETF.
Okay, for everyone listening, why is a Form 8A filing such a big deal? What does that mean?
So think of the ETF approval process in two stages. First, there's the 19B4 filing. That's the big one that says, okay, this exchange can list this type of product.
That's the permission to build plane.
Great analogy, yes. Then the 8A filing is the final step. It registers the actual securities. It's the final clearance for takeoff. Historically, trading begins within days or, a few weeks of this filing.
And if this gets approved, it implicitly accepts Solana as a commodity, not an unregistered security, right?
Right.
At least for the purpose of the ETF.
Precisely. The floodgates for compliance-gated capital could open. Pension funds, RIAs. All the entities that can't touch altcoins right now suddenly have a potential pathway. And Franklin Templeton is coming in hot with a super competitive 0.19% fee.
Wow. Okay, moving on to stablecoins, we're seeing this clear split happening, an onshore attack versus an offshore downgrade. Let's start with the onshore piece.
U.S. Bank, the fifth largest bank in the country. They announced a pilot program to issue a stablecoin, and they're doing it on the Stellar blockchain.
Okay, why Stellar? With all the attention on Ethereum and Solana, why Stellar?
Because Stellar is purpose-built for settlement, but the real differentiator for a bank is what's baked into the protocol. Stellar has native compliance features like asset clawback and frozen accounts.
Hold on, clawback. To anyone in crypto, that sounds like centralized control. It kind of contradicts the whole point of a decentralized blockchain, doesn't it?
That is the perfect critical question, and the answer is they reconcile it by sacrificing censorship resistance entirely.
So it's not really decentralized.
No. Not in that sense, no. U.S. Bank controls the keys. They can freeze or claw back funds. This is a regulated digital dollar designed for institutions where zero regulatory risk is the only thing that matters. It's a direct competitor to something like USDC, but built on their own compliance-first rails.
And this is happening just as Tether, the offshore king, gets some bad news.
Right. S&P Global just downgraded Tether's stability assessment to a score 5, which they define as weak. The rationale was, their reliance on higher-risk assets and reserves and a general lack of transparency.
So this just reinforces a two-tier system.
Absolutely.
Yeah.
USDT for the offshore and gray markets where speed is everything, and then regulated alternatives like USDC or this new U.S. bank coin for traditional finance, which can't touch anything with a weak rating.
Speaking of networks, we're seeing speculative money rotate into a new Layer 1 narrative, Monad. The MON token launched and just surged 80%. What's the technical thesis here?
The thesis is the parallel EVM. To get it, you have to understand Ethereum's main bottleneck. Ethereum processes transactions one by one, sequentially.
Like a supermarket with only one cashier.
Exactly. Perfect. No matter how fast that cashier is, everyone has to wait in the same line. Monad introduces parallel processing, so...
Now you have multiple checkout lanes running at the same time.
Precisely. So Monad is trying to combine Ethereum's developer compatibility, it's an EVM, with Solana-like speed. They're claiming up to 10,000 transactions per second. Speculative money is betting that this is the winning formula for the next cycle.
Okay, let's turn to the macro and political forces that are providing a huge tailwind for all of this. There was a stunning reversal this week for prediction markets.
Yeah, Polymarket reportedly received approval from the CFTC to operate in the U.S. This is so much bigger than just, letting people bet on elections.
What's the real significance then?
It moves what they call information finance out of the gambling bucket and into the regulated hedging bucket.
Which opens the door for
enormous institutional liquidity. Big financial firms need regulated ways to hedge political risk, economic risk. CFTC approval means these markets can now be used as legitimate derivatives, not just for speculation.
And on that same regulatory front, there's the proposed Bitcoin for America Act. This one seems huge.
It's a big one. It was introduced by Representative Warren Davidson, and it targets the single biggest friction point for Bitcoin adoption as a currency, capital gains taxes.
So how does it work?
The core mechanic is really elegant. The bill proposes letting U.S. citizens pay federal taxes using Bitcoin. And this is the key. Doing so would not trigger a capital gains event.
So you don't get penalized with a tax bill for using it to pay your other tax bill.
Exactly. It removes the tax penalty in that one specific context. But the bigger strategic implication is what happens to the Bitcoin the government gets.
This goes right back to the sovereign bid theme.
It does. The bill says that the Bitcoin received by the IRS wouldn't be sold. It would be held in a strategic Bitcoin reserve.
It's a passive accumulation strategy for the U.S. government.
A formal passive accumulation mechanism. They aren't printing dollars to buy it. They're just accumulating it through the nation's tax base.
All of this while the macro environment is looking better and better for risk assets. We're waiting on PCE inflation data, jobless claims.
And that data is critical because the markets are just overwhelmingly positioned for a Fed pivot. Muted PPI, a cooling labor market. The odds of a December rate cut are up to, 85% now?
And any sign of weakness in this new data will likely weaken the dollar index, the DXY.
Which is the mechanical link back to Bitcoin. Since Bitcoin is priced in US dollars, a weaker dollar means it takes more dollars to buy one Bitcoin. It's a mathematical lift, a tailwind, regardless of any crypto-specific news.
Okay, before our final check-in, let's touch on the miners. JP Morgan just upgraded Cypher and CleanSpark, and it seems like the entire way we value them is changing.
The market has fundamentally shifted. The new metric isn't just hash rate anymore. It's power capacity, measured in megawatts.
So it's not about how fast they can mine, it's about how much power they control.
Exactly. Miners with flexible, low-cost power are being re-rated as AI and high-performance computing data center proxies.
What's the financial logic there? How does that decouple them?
It's all about risk reduction. A miner's valuation is tied to the very volatile price of Bitcoin. But if that same miner can lease out its power and infrastructure to an AI company, they get a stable, recurring revenue stream from a multi-year lease.
Which transforms them into a reliable infrastructure, play first, and a Bitcoin miner second.
It fundamentally decouples their stock price from Bitcoin's daily swings. It's a massive structural evolution.
Okay, quick look at the charts. Bitcoin is trading around $87,050. It's eyeing that $90,000 resistance. The support zone at $85,500 to $86,000 held firm.
We should also mention the short-term lag for Ethereum. An early ETH ICO whale sold about $58 million worth. The market absorbed it, but that localized pressure explains why ETH isn't quite keeping pace with the BTC recovery. It's a temporary supply thing.
And finally, we have to end with a critical security alert. This is actionable, especially for anyone using Solana DeFi.
Yeah, this is important. Researchers found a vulnerability with a malicious Chrome browser extension called Crypto Copilot. It was injecting hidden scripts into transactions on DXs like Radium to redirect funds.
And this wasn't a hack of the Solana blockchain itself, right?
No, crucially, not a blockchain or smart contract hack. It was a Web3 front-end attack, exploiting user trust in browser extensions.
So what's the immediate takeaway? What should people do right now?
You have to audit your browser extensions immediately. Remove anything you don't use daily, especially anything that promises trading assistance. And this is the clearest reminder possible. You must use a hardware wallet and verify every single contract interaction on that physical screen. If you don't recognize what's on your device's screen, do not sign the transaction.
What a dive. We've gone from the Texas State Treasury to a potential Solana ETF to a complete rethink of stablecoins and miner valuations. I think the core takeaway here is structural. The market is re-rating Bitcoin, transitioning it from just a speculative asset to a component of multi-generational sovereign capital.
That transformation is happening right now. And as you process all this, consider this long-term implication. The Texas Purchase and that proposed Bitcoin for America Act, they suggest that powerful entities within the U.S. government are moving from just trying to regulate Bitcoin to becoming active holders and accruers of the asset. So when the government is creating a passive strategic Bitcoin reserve using the nation's tax base, what are the inevitable fiscal and monetary consequences over the next decade? That passive accumulation strategy, it changes the game entirely.